For those not familiar with Morien, we're a bulk commodity company. We have royalties on two projects in Nova Scotia. The first on the left is the Donkin coal mine, where we have a high value 2 to 4% royalty. The mine's received over 250 million of capital investments since 2015. The operator recently idled the mine. That'll be the focus of my presentation today, and I'll get to that in a moment. I won't touch again today on the middle royalty. This is a royalty on a crushed stone project or aggregate. It's in Guysborough, also Nova Scotia. This is a 500 million ton Class A crushed stone. It's a 50-year project. It's awaiting a development decision from the owner, Vulcan, fully permitted. They're a 20 billion market cap NASDAQ listed producer, North America's largest, in fact. It's currently paying us, while we await a development decision, about $100,000 a year in advance payments. And we think when it's in full production, it'll be paying us close to $500,000 a year for the 50+ year mine life. And in terms of capital allocation and capital management, I think it's one of the differentiating factors of our company. You know, we have got just under $3 million in cash, but we haven't financed this company since 2014, 7 years ago. We have a very low burn rate, no debt, and an active share buyback program. So our business model right now is quite simple. We're dedicating a substantial amount of our time and efforts to exploring all available options for the restart of the Donkin mine. In the meantime, we're being quite opportunistic with our share buyback program. And if Donkin does go back into operation, we would look to reinstate our dividend program. Since 2017, Donkin's paid our company about $2 million in royalties, and we've dividended back about 80% of that. That dividend program was suspended when the mine was put on care and maintenance, but it's this type of high payout structure that we would look to reinstate when Donkin, and if Donkin does go back into operation. And on the fourth point, you know, we would look to restart our project generation and royalty acquisition efforts, which were well underway prior to the mine being idled. So in terms of Donkin, it has one of the largest resources of any metallurgical coal mine in North America, giving it that 25-year mine life. As I mentioned, it's received a substantial amount of money and investment to date. The mine's permitted for 3 million clean saleable tons a year. In terms of the product mix, it's called a swing coal. It's not that unlike some of the Northern Appalachian coals in the US. It means it can sell either into the steelmaking or metallurgical market or into the thermal electrical market. This gives it great versatility, although ultimately the mine would be exporting predominantly metallurgical coal. And unlike its US competition, at least on the East Coast, which has hundreds of kilometers from mine site to port, Donkin is a 30-kilometer, very short truck haul distance, giving it a tremendous cost advantage. Our royalty is structured such that we get 2% on anything under 500,000 tons per quarter and 4% on anything over that per quarter. And the operator is a company called Cameron Collieries. They're a wholly owned sub of the Klein Group. And if you're not familiar with the Klein Group, they ran 3 of the 4 most productive longwall mines in the United States before they sold that company to Murray Energy in 2015 for a little over $1 billion US. Highly efficient, very well respected coal operator. So on Donkin, the situation is such that Klein placed it on care and maintenance in April of last year, citing adverse geologic conditions. It's an underground mine, and as such, they experienced some localized geology issues regarding roof stability. It's a common occurrence, not just in underground coal mines, but copper and zinc. The key is spotting the poor roof conditions so that no one gets injured. No one was ever injured at Donkin. But it did result in some temporary and localized suspension of operations, which were then remedied by, bolstering the roof, working with the Nova Scotia regulator. There's a few moving parts to finding a potential solution here, but to be clear, it'll ultimately be contingent on Cameron's decision to recommence operations. The mine has not been sealed, no equipment's been removed. It's being maintained by a crew of miners and staff. As I mentioned, they've spent over $250 million developing it, and one doesn't easily walk away from that level of investment. On the last bullet there, a critical component to the Donkin mine is the PEV port. It's 30 kilometers away in Sydney, Cape Breton. The port's responsible for handling all of the Donkin coal, and Cameron is its sole customer. The port is owned by Ernie Thrasher, and Ernie, if you're not familiar with Ernie Thrasher, he was on the board of Barrick. He's the CEO of X Coal, Coal is the largest exporter of metallurgical coal from the US. So Ernie and his one of his companies owns PEV. He's recently purchased an upgraded ship loader, which arrived on site in the summer. You can see it here in the photo. And they've also recently finished dredging its berth to receive larger Cape-size vessels, which will significantly cut the transport cost when sending Donkin coal to one of its primary markets in Asia. And just a final comment before moving off this slide, the Nova Scotia public is generally underinformed when it comes to Donkin. And we at Morien believe strong, vocal, and informed public support for the mine would go a long way in assisting to getting it reopened. And so since the mine has been idled, we've been trying to improve the public narrative with politicians, both provincially and federally, local government, industry leaders here in Nova Scotia to try to correct some of the misconceptions that are out there on the mine. And, you know, as a consequence of that, we've received nothing but positive feedback from everyone that we've met with. So a frequent Donkin-related misconception is in regards to coal markets. And if you listen to the North American press, you would probably think that coal, as a commodity goes, is disappearing. But what I'll show you in the next few slides, I think will prove otherwise. First, coal can be, broadly speaking, divided into two types. You have your metallurgical coal, which is used to make steel, hence it's commonly called steel-making coal. And you've got thermal coal used to produce electricity. These are two entirely different products supplying very different industries, very different values per ton, incredibly different volume trajectories going forward. Metallurgical coal, literally there's no replacement for it in the manufacturing of steel. And so its, you know, use as far as commodity goes is pretty well locked in for the next 20 to 30 years. They are working on green steel alternatives, but they're nowhere near being commercially viable, and they're decades away from that. Thermal coal is used to produce electricity, and we all know it has competition in the form of natural gas, hydro, you know, solar and wind, nuclear, and yet it's by far the largest single source of global electricity generation at 37%. You know, there's certainly limited supply of both coal types given ESG constraints, which I discuss on the bottom row here. What that's doing is limiting the amount of, you know, financing that's available for new developments. Steelmaking coal is generally given a pass, but it still does get grouped in with thermal coal by some fund managers. But all this does is increase the long-term value of mines like Donkin, which are fully permitted and sitting on a deep water port, which, you know, give it the one thing that it needs these days, which is access to overseas markets. So I'll now briefly touch on why we like steelmaking coal. Of the 8 billion tons of coal that's produced annually, only 1 billion tons is steelmaking coal. And of that 1 billion tons, only 300,000 tons is exported into the seaborne market, like Donkin. So it's a fairly small industry by comparison to thermal coal, and yet it's of incredible importance given that you need 0.8 tons of metallurgical coal to make just 1 ton of steel. And importantly, without steel, none of the renewable energy sources would be possible. Every renewable energy source, a wind turbine, a solar PV field, they all require steel. And the driving force, you know, behind steel demand isn't necessarily renewable energy, it's urbanization. We're moving to cities. Our population is growing generally 1 to 1.5% every year, and it's expected, according to the UN, that by 2050, 70% of the 10 billion people that live on this planet will be living in cities. So the majority of this growth will take place in Asia, as you can see from this chart. The fundamental truth is that you can't build or expand these cities, or any city for that matter, without steel. And you can't build steel without metallurgical coal. So it's for reasons like this that Wood Mackenzie, which is, you know, a leading analytics firm in our business, estimates that global seaborne met coal should increase by over 30% in the next 20 years. And you can't talk about commodity demand these days without putting it into the context of the pandemic. These are some of the key steel demand regions around the world. And just a little anecdote, by I think it was May last year, almost every steel analyst on the planet thought that the global demand for the year would drop by between 6 and 7%. By October, that had been revised to 2.5%. And by the end of the year, it turned out that steel demand only dropped by 0.9%. The reason for the constant revisions was because nobody knew just how quickly China would recover. China represents over 50, I think 54% of global steel demand, and the country produced a record 1.1 billion tons of it last year. It's the first time we've ever exceeded 1 billion tons. Um, and then looking forward to 2021, it's projected we'll see a 5% increase in demand. I don't think China's steel demand is going to grow nearly as much. We're just not going to see that level of scope of stimulus that we saw from the country last year. But India, which is already back to pre-COVID levels, Europe and Turkey, they're all expected to rebound significantly. Blast furnaces, they're pretty much back online. Economies outside China are growing again. And so what does this mean for seaborne steel demand, or steel making coal demand rather? It should increase by 10% this year and roughly 6% next year. We've seen some high cost production come offline in places like the US, which could constrain supply, but I think the real supply constraint over the medium and long term, especially, will be limited capital investment into those new mines, mostly related to those ESG constraints I talked about earlier. But ultimately, global population growth, urbanization, a growing middle class, these are all the long-term drivers that are going to set steel up for 20, 30, 40 years of growth. And consequently, the steel making coal required to produce it will grow as well. So the Donkin mine did export a small portion of its coal into the thermal coal market, so I'll discuss this briefly as well. As I mentioned earlier, thermal coal provides 37% of the world's electricity. It remains the largest single source of global electricity. Coal's share of the mix is dropping for sure, but to put it into context, it's only dropped 1% in 3 years. It was 38% of the grid in 2018. The reason for thermal coal's longevity or staying power is because the world's energy demand grows by 2% every year. So that pie chart gets bigger by 2% every year. And this growth, which is not often talked about, but is the elephant in the room, in my opinion, whenever you're talking about the energy sector, that level of growth limits the pace at which the power sector can decarbonize itself. And then this reality is for sure, I think, best portrayed on this chart, which shows growth in energy demand, or energy supply rather, from the top 6 energy supply fuel types from 2010 to 2019 for each fuel type. And so with the assistance of massive government subsidies, renewable energy, or solar and wind, have grown at phenomenal rates, but yet they still only contribute 5% to the global energy grid. The reality is that the world is, certainly shifting towards renewable energy in North America and Europe, but the pace is not fast enough to offset the impacts of growth, from worldwide economic expansion that's happening in Asia. So this chart shows global coal consumption from 1965 to 2019. And so while the green and the blue, which are North America and Europe, decreased their thermal coal use, the Asia Pacific is ramping up. In 2020, last year, China built 3 times as many new coal plants as all other countries in the world combined. 3 times. And this was the equivalent of adding 1 new coal plant per week in China. They also started development on over 70 gigawatts of new plants on top of that. That's 5 times more than all other countries combined. And they issued permits for new plants at a pace that was 3 times what they did in 2019 before the pandemic started. And it's not just China. Southeast Asia imported 30% more thermal coal last year than they did in the prior year. Their electricity consumption in the Southeast Asian region is, or the Asia Pacific region rather, is expected to double by 2040. So my point here is just that thermal coal has a role to play, and we can debate on whether they're going to be 25% or 30% of the grid 20 years from now. But I just think in order to understand that role, you have to understand what's happening in Asia, where renewable energy is really struggling to keep pace with the growth in electricity demand. I think that really does support that thermal coal story in terms of its long-term demand, at least for the next 20 or 30 years. This is an 8-year price chart for Donkin quality metallurgical coal and thermal coal. Thermal coal is on the bottom and met coal is on the top. The decline in coal demand as a result of the pandemic resulted in thermal coal hitting a low of 37 USD a ton in May, and semi-soft metallurgical coal, this is the spec that Donkin typically trades under, hit 97 a ton in August. Both have since shown signs of improvement, as you can see from the red bubble on the chart. This is just in line with global economic recovery and energy demand and steel demand, and steelmaking coal has gone up 40%, and thermal coal's gone up 90%. We're still quite a ways away from the highs of 2018, but there's good reason to think coal prices will keep climbing, given where demand is headed. And so to wrap up, I'll give you a quick snapshot of some important corporate items. Here's a graph of our normal course issuer bid, which has been active since 2015. Since Dawson went on care and maintenance in April last year, we've purchased back 1.3 million shares at an average price of 17 cents. So because we haven't financed this company in 7 years, and because we've always had such an active share buyback program, we've managed to actually decrease our total shares outstanding in this company from 60 million down to just over 50 million today. And as we wait for a development decision at Dawson, not surprisingly, we're busy reducing overhead costs, which have been down 40%, and they're projected to decline by another 15% this year as well. And there is one thing that is going up, that's management and directors' ownership, which now sits at 14% of the company. Our next largest shareholder is the Klein Group, owner of Dawson, at 11%. And so just to wrap up, there are many reasons to own or buy stocks. For many, it's the possibility of an upcoming event like an FDA approval or a successfully drilled oil well or a big gold intersection. Unlike most event stocks, which have follow-on chain of events, whether it's delineation drilling or approvals or First Nation support or financings, Morien's event's quite binary. It's a single all-in event. There's nothing else that's needed. It's a turnkey project that's already been financed. It's fully permitted. We don't know what Klein's plans are in relation to Dawson, nor what the development timeline looks like. But when things become clear that Dawson will reopen, the market's re-rating event for this stock, I think, will be quite significant, especially given that our annual royalties, which should be in the range of 6 to 12 million a year, will be more than our current market cap. And most royalty companies, even the pure play ones, typically trade at a high multiple to their annual cash flow. I'd say in the range of 6 to 8% for the pure plays and upwards of 15% for the diversified royalty companies. And we're giving confidence in a positive outcome based on the fact that Klein has spent 250 million developing the project and that the mine is being maintained in an idled state. Precious metal royalties typically have lifespans of 8 to 10 years, sometimes 12 years. Morien's royalties are 25 to 50 years, so very long life. Coal demand is strong, and despite what you might read in the Western press, it isn't going anywhere. We have a very strong balance sheet for a company our size and no debt. An active share buyback program, which we'll be opportunistic with throughout the year. And ultimately, our goal is to reestablish that quarterly dividend and get back to our core business of distributing cash to our shareholders. This event will clearly be triggered when Dawson is put back in production. And in closing, I just want you to know that when it comes to assisting in the restart of Dawson, we're dedicating an awful lot of time to things that are immediately visible. And I'd be happy to elaborate on those things over a phone call with an investor on this conference today or over email anytime. And with that, I'd be happy to field any questions.
Thank you, Dawson.